Hey guys, thank you so much for joining us today. I have with me the amazing Christina Abney from Prime Lending. We're going to be talking today about lending and how to get pre-qualified and pre-approved for a loan. Christina, correct me if I'm saying this wrong, but pre-qualified, right? Pre-qualified and pre-approved for a loan, which is one of the first steps that any buyer who has any interest in applying for a loan to purchase a home will need to do before going out to go shopping. So Christina, tell us a little bit about yourself. Tell us a little bit about your company, please.
Nice to meet whoever is watching this video. My company is Prime Lending. We clear through Plains Capital Bank that's based out of Dallas, Texas. We have quite a few locations throughout the country, pretty much have a presence in every state, I believe, or if not close to that. I'm based out of the Mount Pleasant branch in South Carolina. So Denise and I are about, I'd say, 35 minutes away from one another. I've been in the industry on and off since 2002. So things were very different before the 2008 mortgage crisis. So quite a few things have changed, which leads us up to why you and I are having this conversation today to kind of iron out some details in the home buying process.
Right. Yeah. An important conversation to have as well. So Christina, tell me, why is it important for a home or a potential home buyer to come to see you before house hunting?
Well, it kind of leads back to the term pulling the cart before the horse, right? You definitely want to find out what you qualify for before you start going and looking for homes. Otherwise, you may be a little upside down and looking in the wrong price bracket.
Right. And, as I tell any potential home buyer, it is so hard for you to unsee a home that you've fallen in love with. That's out of your price point.
We don't want any broken hearts out there. So
I know. So stay off the those sites that yeah, we're not gonna call out any particular sites, but yeah, just find out what you qualify for first before actually going out to hunt. So for someone who's applying for a home loan for the first time, tell us about the process. Kind of walk us through the process of what they want to do first. How do they initially contact you to apply for a home loan?
Couple of different ways. Denise, you can refer them to my website to apply. That would be a preferred method if there are no outstanding questions up front. That will give me a chance to be able to receive the application in my internal system, review the application, get all my numbers straight from being able to look at their credit and their finances, and then call them to have an initial conversation about where they're sitting currently and being able to address any specific issues.
And I'll make sure to post your website along with this video so that people will know exactly how to contact you. Are you doing a lot of in-person interviews these days, Christina?
Can't say that I am. Given the current state of things with COVID, we try to kind of minimize, face-to-face meetings. Doesn't mean I haven't met with clients. It's just few and far between. Our process now is so streamlined with pretty much, I wouldn't say everything, but almost every step of the process being electronic, that it's usually too convenient for people to resist and instead of them having to drive and sit in the office. However, I am receptive to meeting them if it's a situation where they feel comfortable, more comfortable doing that.
So once someone contacts you and they say, hey, I want to see if I qualify for a loan, tell us about what you're looking for to get them pre-qualified or pre-approved.
Okay, so typically the first stage would be the application. So again, my website has a place where you can actually click on it to apply now. It'll take probably about 7 to 10 minutes of their time. And once they move through the application, any questions that are not applicable, you just skip over to continue and then click submit, and then that will push everything into my software. Once I'm able to review your application and their credit and anything else that may come up throughout the process, it'll allow me to build a list of questions for the initial conversation I have with them. Once we talk, that number that I'm coming to for a good place to start with a house price range is dependent on what information they've put in the system. So to be able to kick out a pre-approval, I'll need supporting documentation so I can pair up their income docs, their asset docs with what they have put on the application to make sure that their interpretation of their income would be the same as our lending guidelines.
And what are those supporting documentation documents that you're referring to? What type of, what are you looking
if
for?
they're W-2'd, it would be the most recent 2 pay stubs, most recent 2 years W-2s, any asset statements to support reserves and cash to close, and then a copy of their driver's license.
Okay. Now, suppose someone isn't W-2, they're self-employed. How does the process differ from a W-2 person versus a 1099?
Just how we view the income. So with somebody that's 1099 or someone that is fully, self-employed, owns their own business, those would be their income would be supported by their tax returns. So we'd ask for the most recent 2 years worth of tax returns instead. So I can go ahead and look at their net income after their expenses.
Okay. All right. So it's important to make sure that you do have at least 2 years that you file taxes.
2 years that you file taxes, and also 2 years that you've owned the business. So you may overlap 2 years and not quite have owned the business for 2 years. So we definitely want to know that you've owned the business for 2 years, and that your 2 years tax returns that you're providing have gone up in income. If they've decreased, like let's say 2019, you earned $50,000, and 2020 you earned $25,000, we're going to have to use a lower of the two.
Okay.
So we're just kind of looking for an upward motion as far as that you're improving in your business.
Mm-hmm.
And then also we'll take an average of those 2 years of your net income over those 2 years after deductions.
And Christine, tell me if this is something that would be too long to get into with this particular interview, we can schedule another one. But how have things changed with COVID as far as pre-qualifying or independent contractors, self-employed? How have things changed as far as the qualifying process?
Well, guidelines have tightened. So whereas we used to be able to go down to a 580 score, our minimum score now is a 620. And these are agency requirements as well that get instituted to protect the risk of fallout. We also are going to be following up with verification of employment, either calls or just what they call verbal or written, verifying that the person still works there closer to the closing date, things like that. We just want to make sure, just due to the fact that there's just such a higher risk of people, becoming unemployed and losing their job, unfortunately. And we want to, obviously limit the risk for us as well. So those are mainly the two things that I've seen. On a qualification note, if somebody lost their job but is now back at the same job, and they are back to their pre-COVID, income, we just need, a verification from from the employer that they have, returned to their normal income to be able to move forward.
All right. Let's talk a little bit about once they've submitted the application, and of course we understand that the pre-approval is something that is important to have when submitting an offer, and we're not going to get too far into offers or house hunting and things like that, but that's, just to kind of give you guys an overview, that's something that a seller wants to see. When you submit an offer, they want to know that you've been pre-approved or either have funds in the bank to cover the cost of the home. What is the difference between pre-approval and pre-qualification? I know we didn't talk too much about pre-qualification, but there is a difference between a pre-approval and what's called a pre-qualification. Can you tell us a little bit about those two?
You'd be surprised at how many times those terms get used interchangeably.
Mm-hmm.
But really, a pre-approval is when we've been able to set eyes on their documents.
Mm-hmm.
And so that's what that seller's looking for. They're looking to make sure that the lender has fully verified their income to the best of their ability prior to them kicking out that letter. A pre-qual really is more of just, we received the application, we're going off of what the borrower is telling us, for their income and assets, but we haven't, gotten hands on their documents yet.
Once a client is pre-approved or pre-qualified, you can basically kind of gauge based off of their income, the information that's given, kind of what their interest rate is going to be. Is it safe to say that, a client or someone who likes to go on the internet and look at today's going rate, is it safe to say that, hey, that's going to be necessarily their rate? Today's going rate, explain that a little bit for those who may go online and say, oh, today's rate is at 3.5. So that's what my rate is going to be if I go and qualify or get approved for a loan today. Is that a correct statement?
Okay, so no. Well, a couple of things. But they do vary based on the lender. So, the lender has control over what rates they're releasing for that day. Now, the rates are loosely based on the 10-year treasury. Besides that, it's hard to really give a direct connection that a borrower can kind of hold on to each day to be able to get an indication as to where rates are. That's kind of why there are loan officers here to provide that information. But it also, credit worthiness has an impact.
So looks like we're having a little technical difficulty here. Hopefully we can get Christina back. We'll just give it a few seconds. Okay, we'll see if we can't get Christina back here in just a moment. Okay, so we've got Christina back here. All right, Christina, you were saying?
I was saying that there are a lot of different aspects to a person's profile as to whether or not they qualify for a specific interest rate. So credit has a big impact on that, as well as loan to value, how much money you're putting down on the loan, the type of program you're qualifying for. So to be able to just kind of internet surf and try to use those rates to base your individual situation off of it would be kind of erroneous.
Yeah. So in other words, it's not a one size fits all type
No.
deal. Yeah. It's a case by case situation.
Correct.
Let's see. As far as rates go, so that day when a person applies for their loan, and you're basically able to give them a rate that day, Is that to say that that's the rate that they're going to have in 10 days, 15 days, 20 days, as the loan goes on? What are some of the pros and cons? Tell us a little bit about what's called a rate lock-in.
Okay, so rates change multiple times a day sometimes with our company and other lenders as well. With that being said, you are not locked into a rate until we actually lock you. So what that means is the time of the application, we are not permitted to lock. So we don't lock interest rates. You don't have the opportunity to lock until you get a contract out. So until then, it's just kind of best case scenario at that current day, you know, that's what we're basing our talks off of. Once a contract goes down, I'll review what the current day pricing is with the client and talk with them as to whether or not they're interested in locking a loan or if they still would like to float. Floating just means that you have not locked in because you're looking for a more advantageous price. If they do choose to lock, and let's say the market drops significantly, we do offer a one-time float down within the life of the process, you know, during the purchase process. So if let's say 10 days down the road, the rates drop from, you know, a certain amount to a certain amount, we can look into possibly seeing if they're eligible to be able to float down their interest rate. Okay. While still having the security of having their rate locked and, you know, and not having to go higher, which is the ideal scenario.
So that would basically be up to the client to decide if they're ready to lock in their rate.
Correct.
After they're under contract.
To the client. Yeah. Now the client may ask my opinion in the matter, but and I'll tell them what I think, but essentially it's the client's decision.
So you were saying that generally the you guys want to see a 620 credit score in order to become qualified for a loan. Tell me about the credit score for those who or the type of loans you know, for each credit score. So someone with a 620 credit score, are you looking necessarily at specific loans for people in that category versus someone with a 750 credit score or 800 credit score? Are there different loans that you're looking at for those clients?
Yeah, so to be clear, 620 is our floor. So we need an approve eligible. So what that means is we have a thing called an automated underwriting system. It's called AUS, and it allows us to be able to talk directly with Fannie Mae, Freddie Mac, FHA, VA, USDA. Well, USDA uses GUS, but anyway, so this enables us to be able to run the application quickly to those agencies and get feedback as to whether or not that agency likes that client situation. Certain loans cater to certain types of borrowers at that moment. So for example, if you have had some challenged credit, you'd more likely qualify for FHA than you would for Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac actually can go pretty low in their credit score, but it's rare that we can ever get an approve eligible at that score. So typically, if you know credit scores are on the lower end, the first place I'll visit is an FHA loan.
Okay. Tell us about the different types of loans for maybe investors or second homes. The down payment that would be you know, required for an investment loan, or a primary. If you're looking at, and I know this is a lot, but for like primary, this is your primary residence, and possibly a FHA loan, what would be the down payment that they're looking at for that type of loan? And a VA loan, because you're going to have, you know, you do deal with, you also do clients who are going VA. Mm-hmm. And fees associated with the VA, or misconceptions about VA loans.
Okay, so with primary residences, there is less of a risk with that property. So agencies typically will go a lot higher with financing, meaning less down. Now, obviously, your credit score needs to be at a certain point with some of these types of loans to be able to qualify going that high. But like, for example, FHA, you can go to as little as 3.5% down. With VA, you can finance actually up to 100%. And Prime in particular, we really appreciate our vets, and we don't charge lender fees on VA. So that's double bonus there. So it just really depends. Again, it's going to be per situation, but as per those guidelines, that's kind of the basis as far as what little down you can put down. Now, with that being said, certain programs allow for gift funds. So if the person doesn't have the 3.5% down, they can look to a close family member, even in some cases a close friend, to be able to have them help them out with that money. So that may be an option. And also another option for help with the process of down payment would be like a state housing loan. State housing has programs available to be able to assist with that down payment. Now, closing costs are a different story. So you've got two pots. One is down payment. The other one is closing costs. And the total between those is your cash to close. So the closing costs.
We'll talk about closing costs in just a moment. Yep.
Yeah. So I guess we'll circle back around to that, but I can tell you kind of how to maneuver with that as well in certain situations.
Okay. So you were talking about state housing loans, and tell us who would normally want to look into state housing loans. There's a state housing loan, and then there's what's called a USDA loan, correct?
Yeah, so they're completely two different things. Not even in the same kind of realm. Mm-hmm. State housing is offered by the state, and it's there for to encourage people in our state to be able to purchase homes. It's a great program. They have multiple ones, but they're similar. Some of them are on a bond platform, other ones aren't. It's depending on what your situation is, depends on which one would be best for you. They are extremely strict with debt ratios. If you're some of these state housing loans, I would venture to say the ones that I know about, the back end ratio can't go above 45%. So if you're at 45.02, you would not qualify. So, and there's no ands, ifs, or buts. So you just want to make sure that we and us as LOs have to do a really good job of making sure that we're analyzing that income properly based on the programs to be able to make sure that there's not a risk there of you exceeding that debt ratio later on in the process.
I do probably want to come back and, at a later time and talk a little bit more about these different types of loans, because I know you have a lot of information on these loans.
Generally, state housing itself could take a whole nother, 30 minutes. I will say with state housing as well, there are income limits. And if there was kind of a similarity there between state housing and USDA, they both have strict or, tighter debt ratio requirements, and also income limits. So you actually have to stay below a certain amount of income to qualify versus above.
Okay. And USDA loans, tell me a little bit about the USDA loans.
USDA is our loans that it's another agency, government lending. They usually lend in zones in certain areas that tend to be more rural. Mm-hmm. Agricultural, they will also finance up to 100% for, people that can get an approved eligible with them.
Okay. Again, I think a lot of this stuff, you've got so much information on this, and it's not something that we'll be able to cover in one setting. So we'll have to split those up and hopefully come back another time and talk about those. But talk about closing costs, because again, people can get it confused between your down payment and your closing costs. As a rule of thumb, what would you say would probably be a typical closing cost, the closing cost for the average home buyer? And average, I'm talking about, we're looking at average homes maybe about what, 225, 240 price range or something like that. We
Mhm.
don't want to get too far out, but because that's kind of what we're looking at these days. So tell me about the closing costs. What would people expect in that area?
Yeah, so I'm not going to go specific on numbers there,
Hmm.
just because, I'd have to probably calculate that when the application comes through.
Right.
But some closing costs are the cost to be able to get you in that home,
Hmm.
as far as, anywhere from lenders' fees to closing attorneys' costs, your prepaids for your escrow, for taxes and insurance. Um, so there, even, on the front end, we show the appraisal fee to be wrapped into that as well, although that's usually paid out of pocket.
Right.
So those are some examples of closing costs. Your down payment is the actual amount down that you're putting into purchasing your home. Lenders usually want to see some skin in the game. So that's where that comes into play. And then those two total your cash to close. Both of those added up would be the total amount that you'd have to come up with to be able to buy the home. At a amount out of pocket, I should say, and not financed. So that's it in a nutshell. Now, with that being said, certain programs allow for seller concession. So that's kind of where you come in, Denise. If you have a buyer that's interested in buying a home but just doesn't have that much cash to spend, they may be able to shoulder the down payment, but not so much the closing cost side of things. So, you could wrap in to your offer possible seller concession. For example, FHA allows you to go to 6% seller concession. So that's probably more than you would need in most cases. And then Fannie Freddie is typically, I believe, 3% of the purchase price.
Right. And I think the last question that I have, Christina, is how long do you want to, how long would you like to give to close once they go under contract, once a buyer goes under contract? How long does it usually take for them to close on their home or
So,
property?
in an ideal world, 45 days for a typical closing, 60 days for state housing. We can close your typical purchase in about 30 days and state housing in about 45.
Now, in an emergency situation, you have a client, and I know I've put you in situations where, Christina, I need this, I need this, I need this, and you have come through. In an emergency situation, how soon can you get a loan closed?
I wouldn't feel comfortable committing to anything less than 25 days. And even that's probably pushing it, just because things have just been so busy here lately. And we have full pipelines, and, it's tough because you're relying on the amount of time it takes for our underwriters and our processors and all of them to be able to touch the loan. So.
Okay. Christina, thank you so much.
You're
Thank you,
so
thank you, thank you.
welcome.
All right. Well, before we go, did you have anything to add?
No, situation, I guess, specific questions that come up, I'm always here, and you can give my number out to your clients and have them give me a call.
All right. Christina, thank you again so much. You stay safe.
Absolutely.
All right.
You
Bye-bye.
too.